turn on the financial news on any given Tuesday, and global markets looks like this chaotic flashing casino,
Oh,
right?
absolutely. Red numbers, green numbers, analysts just yelling about a decimal point, missing expectations.
Yeah, total panic over a single headline.
Right.
But if you step way back, global finance doesn't actually look like a casino at all. It's more like a giant, slow-moving river of capital.
Yeah, that's a great way to put it. Trillions of dollars, euros, yen, just quietly carving deep channels across the globe.
Exactly. Flowing exactly where gravity and structural incentives tell them to go. So welcome to the Deep Dive. Our mission today is to map out the landscape of Q2 2026 by cutting entirely through that daily white water.
Right, getting past the noise.
Yeah, and focusing on the deep institutional plumbing of global markets. We are going to look at the structural macro incentives driving the world's major currency pairings right now. Like why capital flows where it does, how central banks are physically trapped by their own economies.
And crucially, how you can spot those long-term trends hiding beneath the short-term volatility.
Right, because when you look at the board today, the structural imbalances are just profound.
They really are. I mean, the daily ticker tape might tell you a story about random noise, but institutional capital is moving based on fundamentals that simply do not change because of, a Tuesday morning employment report.
Yeah.
Those deep currents are driven by where capital is heavily rewarded and where it is severely punished. So to understand the entire global landscape right now, we basically have to start at the absolute foundation of market plumbing.
Which is what?
We have to look at the search for yield and what we call a funding currency.
Okay, let's unpack this, because if we're mapping these deep rivers, Japan seems to be like the undisputed source of the current right now.
Oh, 100%.
But, I mean, if I'm looking at Japan's inflation recently, it has actually ticked up. So the obvious textbook central bank move would be to aggressively raise rates.
Right, that's what you'd expect.
Yet the Bank of Japan seems totally paralyzed. They're keeping their rates pinned near zero. Why are they so structurally trapped?
Well, the Bank of Japan is anchored by decades of economic history that you can't undo in a few quarters.
Right.
They've dealt with low inflation and stagnant domestic demand for so long that their entire financial system is calibrated to ultra-low yields.
So they're stuck.
Completely. I mean, look at their domestic debt market. The Japanese government issues a massive amount of bonds, and the Bank of Japan owns a massive percentage of them.
Oh, wow.
Yeah. So if they were to aggressively hike interest rates, the value of all those existing low-yielding bonds would plummet.
Which would be disastrous.
Exactly. It would tear a hole in the balance sheets of their own domestic banks and pension funds. So even when they take, tentative steps toward normalizing policy, the system simply cannot handle an aggressive hiking cycle.
They're forced to stay near zero.
Right. And meanwhile, the U.S. Federal Reserve and the European Central Bank have materially higher rates.
Right. A massive gap.
Yeah. And this divergence isn't just like a fun piece of trivia. It creates the most powerful structural incentive in global finance today, which is the carry trade.
Okay, so just to clarify for everyone, in a carry trade, an institutional investor borrows money in a country where interest rates are effectively zero.
Like Japan.
Right, like Japan. And then takes that borrowed money, converts it, and parks it in the country paying, say, 5%, like the U.S.
Yep.
And they just pocket the difference. So it sounds like the yen is basically a 0% introductory credit card that the entire global financial system is using to fund high-yield savings accounts elsewhere.
That is a perfect analogy, but think about the mechanics of that credit card. The scale of it goes far beyond just a New York hedge fund borrowing yen to buy U.S. treasuries.
Really? How much bigger?
It's actually a dual-layered flow. We also have to look at domestic Japanese investors.
Okay.
Imagine you manage a Japanese pension fund. You have a fiduciary duty to generate returns for millions of retirees, but your domestic government bonds are yielding a fraction of a percent.
Oh, man. So you can't stay home.
You are mathematically forced to send your capital abroad. You buy U.S. corporate bonds. You buy European equities. So you have external speculators using the yen as a funding currency to short it, and internal Japanese capital fleeing the yen in search of yield.
That dual flow creates a massive, persistent current, pushing the U.S. dollar and the euro higher against the yen. So the structural bias is overwhelmingly long USD JPY and long UR JPY.
Correct.
But I mean, I have to imagine this isn't just a risk-free ATM machine.
No, definitely not.
What happens if there's a systemic global panic? Like a situation where everyone suddenly decides they need to pay back that 0% credit card all at once?
Well, that is the exact scenario that invalidates the trade.
Right.
In the institutional world, we look at historical precedents like the fall of 1998, when a massive unwinding of carry trades caused the yen to violently spike in value in a matter of days.
Just days.
Yeah, it was incredibly fast. When there is severe systemic panic, a true risk-off environment, investors don't care about the yield spread anymore.
They just want out.
Exactly. They just want to close their liabilities. So they aggressively buy back the yen to pay off their loans, which creates this massive short squeeze.
Wow. Okay.
But unless we are in a severe panic, the incentive to hold yield remains completely dominant. In a mixed or, mildly risk-on environment, capital allocation naturally flows away from Japan and toward the higher-yielding dollar and euro.
So Japan shows us what happens when a central bank is trapped by a fragile, yield-starved domestic system. But that's just one side of the coin.
Right.
What happens when a central bank is trapped by the exact opposite problem? Let's look at the U.S. and Switzerland. The Federal Reserve is dealing with strong growth, but incredibly sticky inflation.
Yeah, the Federal Reserve's constraint is that inflation simply hasn't fully normalized to their target. It's sticky, particularly in the services sector.
Right, getting that last mile of inflation down is brutal.
It really is. Because of that, the Fed cannot afford to easily or aggressively cut rates. Even if they want to ease their foot off the brake just to prevent a recession, they are anchored to a restrictive posture.
They're stuck high.
Exactly. Now, compare that constraint to the Swiss National Bank.
Okay.
Swiss inflation is contained. Their domestic economic conditions are stable. The SNB operates under far less pressure, which gives them the flexibility to maintain lower rates or even cut them without risking an inflationary spiral.
So this is what we mean by policy asymmetry. The Fed is held at higher rates by absolute necessity. The SNB has the room to remain accommodative.
Right.
Any convergence in their policies is far more likely to come from the Swiss lowering rates than the U.S. entering some rapid easing cycle.
Precisely. Capital flows to where policy is durably tight. Global investors recognize that the Federal Reserve is going to be the last to blink.
I follow the logic, but if I'm looking at this from the perspective of a defensive portfolio, Switzerland is the ultimate historical safe haven.
Sure.
When geopolitical tensions flare up, people buy gold and they buy Swiss francs. Why isn't global capital hiding out in the Swiss franc right now just to be safe?
Well, we have to draw a hard line between persistent flows and episodic flows.
Okay, tell me more.
The U.S. dollar attracts global capital every single day because it offers a very rare combination of attributes: high absolute yield, deep and unmatched liquidity, and reserve currency status.
It's the whole package.
Yeah, you do not need a scary news headline to hold U.S. dollars. It physically pays you to hold them, and you can liquidate them instantly.
And the Swiss francs?
The Swiss franc is a low-yielding defensive asset. It primarily attracts capital only during acute panics.
Right. So if you're listening to this and you're holding Swiss francs just waiting for a rainy day, you're essentially paying an opportunity cost every single day the world doesn't end.
That's exactly it. It's an episodic asset. It only catches a bid when the fire alarm gets pulled.
Makes sense. Since we aren't in a sustained crisis, the structural campaign has to be long the U.S. dollar against the Swiss francs.
Definitely.
Let's move across the border to Canada, though, because the U.S. and Canadian economies are deeply intertwined. They share similar corporate cultures, time zones, all of it. Yet the U.S. dollar is structurally favored over the Canadian dollar right now. Why is the Bank of Canada acting so differently than the Fed?
It comes back to central bank constraints, but the monster trap in Canada is completely different.
What's their monster?
The Bank of Canada is forced to consider a highly leveraged domestic consumer. Canadian households carry a massive amount of debt compared to U.S. households, and the architecture of that debt is totally different.
Okay, let's get into those mechanics. In the U.S., if you bought a house in 2021, you likely locked in a 30-year fixed-rate mortgage at around, 3%?
Yeah, around there.
So the Fed can hike interest rates to 5, 6, or 7%, and your monthly mortgage payment doesn't change a single cent. You are completely insulated.
But in Canada, the 30-year fixed mortgage essentially doesn't exist.
Wait, really? It just doesn't exist?
Pretty much. Mortgages typically renew and reset at current market rates every 3 to 5 years.
Oh, wow. That's terrifying.
Yeah, It means a Canadian homeowner who bought a house at rock-bottom rates a few years ago is now facing a massive payment shock as their mortgage resets at today's much higher rates.
That is a huge difference.
The Canadian economy is therefore incredibly sensitive to the absolute level of interest rates. If the Bank of Canada keeps policy too tight for too long, they will mathematically crush their own consumer.
So the Fed is staring at sticky inflation, but the Bank of Canada is staring at a fragile, debt-laden consumer.
Right.
The Bank of Canada must lean toward easing sooner just to prevent a localized housing crisis.
Exactly.
So because the U.S. is structurally forced to be higher for longer, the play is long USD CAD.
The mechanism is unavoidable. The Canadian economy's growth sensitivity just forces their central bank's hand.
So we're basically building a hierarchy of central bank traps here.
Yeah, I like that.
Japan is trapped by zero-rate addiction and demographics. Canada is trapped by consumer debt and mortgage mechanics. The U.S. is trapped by sticky inflation.
Yeah.
Let's bring Europe into this hierarchy.
Okay, let's do it.
If the Fed holds the high ground on economic resilience, where does the Eurozone fit in?
The European Central Bank is heavily constrained by an outright lack of economic growth across the Eurozone. We are seeing broad disinflationary pressures and persistent economic weakness.
So their engine is sputtering.
They simply do not have the economic engine to sustain highly restrictive interest rates. If the ECB tries to match the Federal Reserve rate for rate, they will plunge the Eurozone into a deep recession.
Right.
The underlying weakness naturally pulls the ECB toward a dovish, accommodative stance.
Though the ECB is trapped by anemic growth. But what about the UK? The Bank of England seems to be dealing with a totally different beast.
Yeah, the UK is facing a uniquely difficult bind, something akin to stagflation light.
Oof, that's a bad combination.
It's terrible. Their economic growth is incredibly fragile, similar to Europe, but their inflation, particularly wage and services inflation, is incredibly sticky, similar to the US.
So they're getting the worst of both worlds.
Basically, yeah. Because of that sticky inflation, the Bank of England is forced to maintain higher policy rates than the ECB. They want to cut rates to stimulate their struggling economy, but they can't because inflation would immediately flare back up.
So let's map this hierarchy out for anyone evaluating their European exposure.
Okay.
The Eurozone is the weakest, forced to be dovish because they have no growth engine.
Right.
The UK is stuck in the middle, forced to hold higher rates because of sticky inflation, even though their growth is terrible.
Yep.
And the U.S. is at the top of the hill with the strongest growth and sticky inflation, keeping their rates the highest and the tightest.
Exactly.
That dictates a very clear directional flow. Capital chooses the U.S. dollar over the British pound. Capital chooses the U.S. dollar over the euro. And within Europe, capital chooses the pound over the euro, simply because the UK rates have to stay higher.
That is the structural reality.
But let me challenge this by looking closely at the absolute rate structure between the U.S. and the UK, because the Bank of England's interest rates are pretty comparable to the Federal Reserve right now. If the yield is nearly identical on paper, why does global capital choose the U.S. over the UK so decisively?
Because institutional capital doesn't just look at the headline number today. It looks at the durability of that yield.
Ah, durability.
Yeah. The UK's high interest rates are incredibly fragile. Because they are actively crushing a sensitive domestic economy, the market knows the Bank of England is under massive growing political and economic pressure to cut those rates the very second they have an excuse to do so.
Right.
But the Federal Reserve's rates, backed by genuine U.S. economic resilience, are durable.
Durability. I love looking at it this way. It's like asking who can actually hold their breath the longest underwater.
Yeah.
The UK looks like they're holding their breath fine, but you look closer and they are turning purple. They are desperate for air. The US is sitting underwater with a scuba tank.
That is exactly what's happening. The market looks at the UK and sees an economy running out of air. Global investors don't just want yield this afternoon. They want the confidence that the yield will still be there 6 months from now.
Makes total sense.
When you combine that durable yield with the unmatched depth and liquidity of the U.S. Treasury market, the U.S. dollar easily wins the tug of war against the British pound.
So we've mapped out the entire board. We see the rivers of capital flowing toward the durable yield of the U.S. dollar and flowing violently away from structurally trapped currencies like the yen, the euro, and the Canadian dollar.
Correct.
But how does a macro campaigner actually execute this? I mean, it all makes logical sense sitting here discussing the deep mechanics, but the daily markets are violent.
They are.
If you're a strategist, How do you position for this without getting completely shaken out on a random Tuesday when the data doesn't cooperate?
Well, this requires separating short-term momentum trading from fundamental macro campaigning.
Okay, how so?
When you have a high-conviction structural view, like being long the US dollar and short the euro, you are operating in a specific mindset. You treat it as a buy dips and sell rallies environment.
So you're not chasing momentum.
You never chase explosive, aggressive price moves. You patiently wait for the short-term data to push the market against the structural trend.
Let's say you're watching the ticker, and a single, slightly cool inflation print comes out of the US. Suddenly, algorithms and day traders panic, and there's a massive red candle on the US dollar. It drops for 24 hours.
Right.
Doesn't the pain of seeing that position go red make you question the underlying thesis?
It shouldn't. As a strategist, you have to look at the underlying mechanics. Did one cool inflation print change the fact that the Bank of Japan is structurally pinned at 0?
No.
Did it fix the Canadian mortgage market?
Definitely not.
Did it suddenly restart the German manufacturing engine? No. The underlying incentives haven't changed.
So it's just an overreaction.
That sudden drop in the dollar is just a positioning squeeze. Too many short-term speculators got on the same side of the boat, the headline forced them to liquidate, and it spiked the price the other way.
Those episodic flows again.
Exactly. Those are episodic flows. For a macro campaigner, that temporary dollar weakness is simply an opportunity to accumulate your position at a better price. You are scaling in.
It's noise versus signal. You aren't playing the daily scoreboard. You are betting on the laws of financial physics. Water will eventually flow downhill. Capital will eventually flow back to the asset with the scuba tank.
It requires total alignment with the institutional incentives. You only abandon the campaign when the underlying incentive structure actually breaks.
Like what? What would break it?
If the Federal Reserve suddenly calls an emergency meeting and slashes rates to 0, the thesis is broken.
Right.
If a massive multi-year global commodity supercycle suddenly erupts, flooding the Canadian economy with capital and saving their consumer, your thesis on the Canadian dollar is wrong.
That makes sense.
But unless those deep foundational tectonic plates shift, short-term counter-trend dips are nothing but entry points. Patience and discipline generate the return.
Let's bring this all together. The primary takeaway from everything we've mapped out today is that in the Q2 2026 landscape, the global system heavily rewards the US dollar.
Heavily.
It is rewarding American economic resilience, policy durability, and unmatched market liquidity. At the exact same time, the system is ruthlessly punishing funding currencies like the Japanese yen and heavily punishing structurally weak economies in the Eurozone and debt-trapped consumers in Canada.
That's the reality of the board right now.
To navigate this, you have to look past the daily noise, ignore the episodic panics, and align your thinking with these deep structural currents.
The direction of the river is very clear. As long as these central bank constraints remain intact, these macro campaigns are simply the logical reflection of global capital seeking the best, safest, and most durable return.
Which leaves you with a final concept to chew on as you manage your own portfolio. Throughout this entire deep dive, we've seen that global capital essentially uses the US dollar as the default cleanest shirt in the laundry basket.
The best option available.
Right. It is the absolute center of global liquidity, yield, and safety. But as you watch the markets move this year, ask yourself this: what would it actually take for the world to diversify away from that?
It's a big question.
If the entire plumbing of the global financial system is currently positioned on the assumption of American economic exceptionalism and Federal Reserve dominance, what happens to these massive, slow-moving rivers of capital on the day that narrative finally cracks?
Something will eventually break it.
It's something to keep in the back of your mind as you watch those invisible currents flow. Keep questioning the consensus, look beneath the surface of the daily ticker, and we will catch you on the next deep dive.